Your portfolio is down 10% over the last few days alone. Each time you look at your investment app, your investment value sinks a little lower. That's not a nice feeling. All that money you just worked so hard for, evaporating in what is essentially a puff of smoke. Stairs up, elevator down, as they say. Now you start to wonder, is this the recession they've been talking about? Is it about to get much worse? You need that money soon, and it'll be a disaster if it falls another 10% down. You pull your money out of your investments in a panic. The problem here is that you ignored a very important concept of investing that you need to really understand before you start investing. It's also the topic of today's video, risk tolerance. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Risk tolerance is your capacity and willingness to handle a decrease in the value of your investments. To assess your risk tolerance, think about how at ease you'd be keeping your investments during substantial market downturns. It could be very low or quite high, but it'll all be down to you and your circumstances, or rather what you want to do with the money you invested. In the context of investing, we're talking about your emotional and psychological ability to handle uncertainty, losses, or fluctuations in your investment portfolio. Some people can stay calm and stick to their strategy even when their investments are down, while others might feel stressed and want to sell off at the first sign of trouble. This emotional reaction is a big part of what we would call tolerance. But what are these risks? Here's a detailed look at each risk associated with investing in the stock market. Market risk. This is the risk of losses due to factors that affect the entire stock market rather than just individual stocks. It includes risks from economic downturns, geopolitical events, and broad market trends. When the overall market declines, stock prices generally fall, regardless of the performance of individual companies. For instance, during the 2008 financial crisis, almost all stocks saw declines due to the widespread impact on the financial system as a whole. Risk of volatility. Volatility refers to the extent and frequency of price fluctuations in stocks. High volatility means prices can change rapidly and unpredictably. Investors may experience significant gains or losses in a short period. For example, tech stocks are often more volatile than stable, established companies, which can lead to rapid and substantial changes in portfolio value if you go heavy in tech stocks. Company-specific risk. Also known as unsystematic risk, this pertains to risks that are specific to an individual company. It includes risks from management decisions, competitive pressures, or internal issues. If a company faces a crisis, such as a product recall or a scandal, its stock price may drop sharply. For example, Volkswagen's emissions scandal in 2015 led to a significant drop in its stock price. Economic risk. Economic risk arises from changes in economic conditions such as inflation, interest rates, and overall economic growth. High inflation can erode purchasing power and lead to higher interest rates, negatively impacting stock valuations. Conversely, economic recessions can reduce consumer spending and corporate earnings, leading to lower stock prices. Liquidity risk. This risk involves the difficulty of buying or selling an investment without affecting its price significantly. It's particularly relevant for stocks with lower trading volumes. In less liquid markets or with smaller companies, it may be challenging to execute trades without impacting the stock price. This can lead to larger price swings and difficulties in entering or exiting positions. Interest rate risk. Interest rate risk pertains to the impact that changes in the interest rate can have on stock prices. Rising interest rates can increase borrowing costs for companies and reduce consumer spending. Companies with high levels of debt or those in interest-sensitive sectors like utilities or real estate may see their stock prices decline when interest rates rise. For example, rate hikes by central banks often lead to lower stock valuations as borrowing becomes more expensive. Currency risk. This risk is relevant for investments in foreign stocks and refers to the impact of fluctuations in currency exchange rates on the value of these investments. If the domestic currency strengthens against foreign currencies, the value of international investments can decrease when converted back. For example, if the US dollar strengthens against the euro, the value of European stocks for a US investor would decline. On Trading 212, you can see the exact effect this is having on your investments by what they highlight as the FX impact, as you can see here. I assume that most of you guys watching this use Trading 212 already at this point, but just in case you don't, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. If you've opened a new account recently or planning to open an account, then here it is, DivXP or DIVEXP. short for the dividend experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading212 for sponsoring this video. There are yet more risks that you need to pay attention to. Regulatory risk, which involves changes in laws or regulations that can impact a company's operations and profitability. New regulations or policy changes can increase costs or restrict business operations. For example, stricter environmental regulations can increase operational costs for manufacturing companies, potentially lowering their stock prices. This risk relates to the impact of political events or instability on the stock market. It includes changes in the government, political unrest, and policy changes. Political instability or unexpected policy shifts can lead to market uncertainty and affect investor confidence. For example, Brexit caused significant market volatility due to uncertainties around the UK's future economic and trade relationships. Psychological risk. Psychological risk involves the emotional and behavioural responses of investors to market fluctuations, which can lead to irrational decision-making. During market downturns, investors may panic and sell stocks impulsively, locking in losses. Conversely, during bull markets, investors might become overly optimistic and take on excessive risk, leading to potential losses if the market corrects. Understanding these risks help investors develop strategies to mitigate them, such as diversification, careful stock selection, and staying informed about economic and market conditions. Now, that's a lot of risks in investing. Maybe we just shouldn't bother. It's understandable to feel overwhelmed by the risks of investing, but it's important to remember that risks are inherent in any financial endeavour, and they can often be managed effectively. Here's a balanced perspective to consider. Risks are manageable. While risks exist, they can be mitigated through strategies like diversification, which means spreading your money across different types of investments like stocks, bonds, or property, and even across different industries or regions. By doing this, you reduce the risk that comes from relying on just one investment. For example, if one company's stock doesn't do well, the impact on your overall portfolio is lessened because you have other investments that might be doing better. This way, diversification helps balance out your risks and can protect your money over time. Another key strategy is to build a well-researched and balanced portfolio. This means carefully choosing investments based on solid information, like how a company is performing or what the market trends are. A balanced portfolio mixes different types of investments to match your goals and how much risk you're comfortable with. Potential for returns. With risks come potential returns. Investing comes with risks, but these risks are also tied to potential for significant returns. Unlike savings accounts or other low-risk options, the stock market has historically offered much higher returns over time. When you invest in stocks, you're essentially buying a small piece of a company. If the company performs well, the value of your investment can grow, leading to profits when you sell your shares. This potential for growth is why many people choose to invest in the stock market, even though it can be more volatile than other forms of saving. Over the long term, the stock market has shown strong overall growth despite short-term ups and downs, and this long-term growth can be a powerful tool for building wealth and achieving financial goals. By staying invested over time and not reacting to short-term market fluctuations, you can take advantage of the market's tendency to increase in value. This approach allows your investments to grow, helping you build a solid financial future. While there's always some risk involved, the potential rewards can make investing a valuable part of your financial strategy. Long-term perspective. Many risks are short-term in nature, while investments typically benefit from a long-term perspective. Historically, markets have recovered from downturns, and maintaining a long-term investment strategy can help ride out market volatility. In summary, while risks are part of investing, they are manageable and should be weighed against the potential benefits. With proper planning, education, and a long-term view, investing can be a valuable component of a financial strategy. How does risk tolerance fit into all this? Understanding and assessing your risk tolerance is a crucial step in making smart investment decisions. Risk tolerance refers to the amount of risk you're comfortable taking on when investing, and it can significantly influence the types of investments you should choose. Several factors play a role in determining your risk tolerance, and by considering these, you can align your investments with your personal comfort level and financial goals. One key factor influencing risk tolerance is your investment time horizon, the length of time you plan to hold an investment before you need the money. Generally, the longer your time horizon, the more risk you can afford to take. This is because the longer time horizons provide more opportunities to recover from potential losses, allowing for higher risk investments that might offer greater returns over time. For instance, someone investing for retirement 30 years down the line can afford to take on more risk compared to someone who needs the money in 5 years for a home purchase. Financial goals also play a significant role in determining risk tolerance. Different goals require different levels of risk. For a long-term goal like retirement, you might opt to take higher risk investments that have the potential for significant growth over time. On the other hand, short-term goals like saving for a down payment on a house might require lower risk investments to ensure the money is there when you need it. Your current financial situation is another important consideration. If you have a stable income, low expenses, and a strong financial safety net, you might be more willing to take on higher risks because you can afford potential losses. However, if your financial situation is more precarious with higher expenses or less disposable income, you might prefer more conservative investments that carry lower risk. Additionally, your investment knowledge and experience can influence how comfortable you are with risk. Experienced investors who understand how markets fluctuate and how different investment strategies work might be more willing to accept risk compared to someone who's new to investing. Understanding these factors can help you gauge your risk tolerance and make informed decisions about where to put your money. Assessing your risk tolerance often begins with a self-assessment. Reflect on how you'd feel in different market scenarios. For example, ask yourself, how would I react if my investments lost 20% in a year? This type of reflection can give you a sense of your emotional response to risk and help you understand your comfort level. Additionally, many financial advisors and investment platforms offer risk tolerance questionnaires. These tools typically ask about your financial goals, the investment time horizon, and how you might react to hypothetical market scenarios. The answers help categorize you into different risk profiles, such as conservative, moderate, or aggressive. Once you have a clear understanding of your risk tolerance, you can align your investments accordingly. Your risk tolerance will help you determine your risk profile, guiding the selection of appropriate investment strategies and asset allocations. For example, if you have a high risk tolerance, you might lean towards a portfolio with a larger proportion of stocks and growth investments. On the other hand, if you're more risk averse, you might prefer a portfolio that includes more bonds and stable investments. By aligning your investments with your risk tolerance, you can build a portfolio that matches your comfort level, helping you stay committed to your investment strategy, even when markets become volatile. This alignment is key to achieving your financial goals, while managing the emotional and financial impact of investment risks. So, in summary, the stock market and investing generally is full of risks. Some you are mentally prepared for, and some you should avoid. It all depends on what your goals and strategy is when it comes to investing. If you don't even consider your risk tolerance when you choose your investments, then you could be heading for an unhappy situation with regards to your portfolio. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!